The equity markets are on a bull run as we approach the new year, but will the good times keep rolling? Joining us right now to answer that question and more on the markets is Morningstar Wealth's Chief Investment Officer to the Americas, Marta Norton. Marta, what do you think? Will this keep rolling on?
I mean, I think there's a good reason to be optimistic about what we expect for 2024 when we take a look at valuations. Even in light of this rally, valuations within the equity market are pretty reasonable. I mean, I think it's when we see returns of this magnitude, it's easy to forget what the broader year has looked like. And a lot of the equity returns here in the U.S. have been driven by AI, with the broader kind of equal weighted market indexes being closer to flat or modestly positive, 5%, 10% returns. So I think there's still a lot of room to run, especially as we look at some of those rate-sensitive areas that have been punished. Regional banks, utilities, small caps, some of these areas seem particularly poised for better results in 2024. And some of that is contingent on the economic data continuing to support this soft landing narrative.
Yeah, I mean, regional banks have actually done pretty well over the last 6 months, which is surprising given the fallout that we saw back in the spring and concerns about something else breaking, commercial real estate and beyond. But you like what you see here.
We do like what we see, and a lot of that is based on the price movement that occurred earlier in the year, though, there was a correction later in the summer as well. So when we take a look at regional banks and we look at kind of their long-term appeal, they're actually not great long-term investments. But when we look at how they behave coming out of crises, and this is looking at a whole range of bank crises going back decades, we actually find that they do quite well. And those are the periods in which they outperform the market. And a lot of that is because of that negative sentiment that gets, put into the prices. So when we take a look at concerns like commercial real estate or higher for longer, and we take a look at the price movement relative to the potential impairment, we actually think the price movement this year has been more severe.
I think what I'm hearing from you is that it's not that you necessarily expect the indexes to run a lot higher from here, but the unloved areas of the market are going to catch up with the high flyers.
I think within the equity market, it's a story of the unloved, and there are those pockets of opportunity. So regional banks being one, small caps being another, utilities being another. I mean, I think kind of it's a question of what don't you own, and right. From our perspective, it's the AI stuff.
Okay, because not that you think AI is not going to pan out, but because they've already run so far.
Yeah, there's a lot of, fundamental reasons to be enthusiastic about AI, but it's a question of what's in the price. And now, I say that knowing that sentiment, can continue to push those prices higher. So it's not necessarily a market timing call. It's just a matter of where valuations sit today.
I do like how you are hedging things. You say if the consumer continues to run ahead, you're going to be okay because you're still holding on the short side of the bond market.
Yes, that's right. So I think one of the lessons we learned from last year was economic projections cannot be the only input that you have into your portfolios. It can't be the driving focus of your portfolios, because everyone last year was calling for a recession, and yet we have the market that we have today. So you really have to pair it with valuations, the base case economic scenario, and then this range of outcomes. And so within our portfolios, you're right, we're looking at the shorter dated space. There's a lot of still, valuation opportunity relative to kind of a fair value perspective of short dated bonds. And they tend to do quite well should the market, we see some scenario where inflation lingers for longer and things don't continue on their current course.
So you're not convinced the moves we saw this week in the bond market are going to last? Maybe this was a shock, everyone thinking that the Fed is really changing course. But if the economic data doesn't support that, you could see it flip again?
Well, listen, I think valuations got to attractive levels. Even at the long end of the curve, we saw the valuations for 10-year bonds, for example, get above what we consider to be our fair value, which has not happened in years. So I do think the valuation story was quite strong. But I think we have to remember that Powell is very focused on the economic data. And while we believe the economic data is going to continue its current trend, I think there's room for volatility there, especially with a market that's so keen to follow each individual data point as it comes in. So, we're enthused about the valuations, but I think we have to plan for volatility here and there.
What happens if the economy takes a nosedive and things come in worse than are anticipated at this point?
Yeah, that's the other side, I guess, of the tightrope that you have to worry about. One is that inflation lingers, that the consumer continues to push. The other side is that these rate hikes that we've already seen, which have been tremendous, and of course at a tremendous pace, that they have a greater impact on the economy than we currently understand, and that we start to see signs of a deeper recession. Now, in that instance, I think you do have to turn to some areas like longer term bonds. I think those areas can be protective of the market. And I also think there's options that you have within your equity portfolio too. So defensive areas of the market have not held up all that well this year. So I mentioned utilities, but also if you look at consumer staples, healthcare, these are areas that tend to provide a little bit more ballast relative to the broader market when we see economic distress. And so I think those are nice areas to have within the portfolio as well.
Marta, I got to tell you, my head has been spinning a little bit this week just with the surprisingly, I guess, candid commentary from Jay Powell and then the market's reaction to all of that, the moves that we've seen. I still can't get over the 2-year sitting at like 4.3%. I can't get over what's happened to the 10-year. I can't get over what that means for mortgages.
That's right.
And I can't get over what it means for equities. I'm still trying to think through all of this. Have you had a similar reaction?
Yeah, I mean, the size of the moves have been pretty astonishing. I don't know if I would have anticipated the bond market reacting with quite so much fervor, but it does give you an insight into how much that higher for longer narrative had been priced in. I remember, if we roll back, it was higher for longer. It was also concerns about kind of the fundamental health of the U.S. government as we had higher interest rates and, lots of debt payments that we had to make. So there were a lot of concerns bubbling up. I mean, the move in the bond market from August really through, I don't know, what are we calling it, October, something along that time frame. It was a pretty tremendous move. So it was a real painful period, and now we're seeing a really positive reaction on the other side.